All right. What's up, money multipliers, BYOB, money school, private money club communities? How's everyone doing today? We are live and direct. Ask me anything. So get your questions in. Answer any questions you have around the infinite banking concept, becoming your own banker, really anything financial related. Let's get into it. Real estate investing, private money. Carson's been doing a lot of surfing these days, so we can talk about Surf's Up dudes. We got Jason down in Orlando, Florida, hanging out with Mickey and Minnie Mouse. So,
well, this is a very short one. Whole life in a trust.
Yeah. Yes.
So, yep. That's corporate owned life. No, it's not corporate owned. It's just your trust owns it. Yeah. I've actually been doing quite a few of these for family banking. So where people have they're doing like 3, 4, 5 policies, and the trust owns every single one of them. So that's another concept right there to keep it all in the family. And the only thing to note too is you can transfer it into the trust at any point. You don't have to start out that way. You can move it into the trust after the fact. Change the ownership.
It's actually easier that way.
Yeah. I'm going through it right now, Joe, with someone who was doing it at the beginning for certain reasons, but oh my gosh, the paperwork, the requests. Yeah. All right. This one says, little Alea says, is it worth opening my own bank if I'm 64, out of debt, and have a $200,000 HELOC?
Yeah.
Because she looks really young for 64. Huh?
Yeah. I mean, bottom line is, you can do lots of different things there with the HELOC, with the policy, do a policy on other people. So there's lots of options. Yeah.
We have to go back to the basics. Any dollar that runs through the policy, you get to keep until you stop breathing. And you're able to use that same dollar twice. So regardless of what age you are, why wouldn't you want to have that opportunity? 2 times.
What?
And then we can move it into an investment.
That's ridiculous. That's too good to be true. You're lying.
And then how about structuring it inside of 3 different investments? So then you can use it 5 times. Just depends on what you want to do.
Yep.
Hey, Brad, you see those questions at the top from Navigate Your Ventures?
So he answered his own question. But we'll dissect it. But yeah, he answered his own question too, and then later on. So Navigate Your Ventures said this. He goes, one of my policies is with Lafayette. Is the loan capitalization the interest I paid for the year, or is it the dividends I received from the insurance company? So
yeah, loan capitalization will be your interest, and then dividends will be paid at the end of the year. But it looks like they did find on the annual statement, that's where you're going to find a lot of the details of your policy growth, your dividends, and also you can request what's called an in-force illustration from your agent and just kind of get an update of what the dividends and everything look like going forward. So your original illustration is going to be based on dividend scales as of now. And then after your first policy year, you might want to do another what's called in-force illustration. So it shows you all the numbers from that point forward. But as we're using our policies, of course, that's going to be, the cash value numbers are going to be changing as we take loans and pay them back. So
on the left side, underneath the policy loan information, it says the interest amount, and then it says the loans repaid, including the interest, and that should be the same amount if you're just paying the interest, if that helps with that question.
Yep. All right. So follow-up question from a little Alea is, how can I learn about my own bank? Well, we have a presentation, so we'll put a link here in a little bit, our mentor link, and inside that link, you'll find a link to a video and just start watching those videos. Additionally, there's some books you can read. Jason's got one of them right there. Becoming Your Own Banker by R. Nelson Nash is a great one. And then just being around this campfire right here, being around this group, being around the Money Multiplier and BYOB team. That's one of the best ways you're here. So this is how you learn.
Yeah, and once you've watched what we call the 90-minute video, done some research, you'll have some questions, and that's where we have a team available to meet with you and have a strategy call to talk about your specific situation, so we can kind of learn more about what's important to you, how you want to use this, how you invest, how you buy things. So start with the videos and the books, and then book a call with one of us.
And then another question here is, what fund is the money in? S&P 500? What happens if the market tanks? Do you take a loss, or is there a zero floor? Well, to be honest, it sounds like you're talking about an IUL, which is not infinite banking, by the way. So IULs can be tied to the markets, have the zero floor, that kind of stuff.
This is a whole life insurance policy with a dividend. So therefore, you own the business. You're going to receive the dividend back, dividend paying. So totally different than putting it into the market with the S&P or anything like that.
And so with whole life, and you can go out to the insurance companies' websites, One America, Lafayette, whomever, and look at their balance sheets and look at kind of where their investments are. You'll see a lot in long-term bonds. You'll see a lot in commercial real estate. So it's not that the insurance companies are putting your money in the stock market and spinning the dial. They're doing long-term strategies with long-term bonds, and then your specific money. If you're in an IUL, yeah, you can play the market with it, but that's not what we do. We use whole life for the guarantees and the dividends, but if you're more interested in what the insurance company is doing with that money, that's where you can go out to their website and look at what they put their money into.
All right. Robert Madden said, "Happy Thanksgiving. Has anybody flipped any equipment recently?"
Yeah, a golf cart. I was going down the hill and got on an incline and just kind of rolled it a couple times. But how about you guys?
No.
I have not. I have not recently.
There we go.
I did as I was walking down the driveway from, the BYOB garage. Who did I see but Ark comes driving up. Yeah, he's like, "Hey, Craig." So yeah, it was kind of cool to see him. But
Yeah, he pulled in and said, "Hey."
Yeah.
Do they slow down in the winter? Do you know, or
I don't know.
I know there's different lifts that Ark was telling me in the past. There's different lifts that sell better at different times of the year, but I don't know what the match is there.
All right. Lil Alea says, "I'm not sure what to invest in." Well, maybe you want to take an answer to that. That's not really a question, but one thing to keep in mind is it's going to come up here in a second.
Not give investment advice.
Yep.
First of all,
To say we don't give investment advice, and infinite banking, in our opinion, is not an investment. So
You have to know, like, and understand what you invest in. This policy is a banking system, not an investment.
Yep.
We do have, just to add on to that, yes, we're not investment advisors and can't give investment advice, but if we think about what a lot of the folks in our community do is operate like a bank where we're loaning money out on collateral. So there's a group that we also run called Private Money Club, and that's where real estate investors and people with money are looking to do deals together. So let's say Joe wants to go out and do some real estate, and I might have money in my policy that I'd like to invest with Joe. So I may loan my money to Joe. Joe puts me in a first position on his property that he just bought while he's fixing and maybe getting it ready for a rental. And he pays me interest, just like a bank. And then when he's done with the project, he might refinance and pay me back out. But so those are some places that you could look at. But what Joe said is spot on. You need to know, like, and understand what you're doing, whether that's real estate or stock market, whatever. I don't know anything about the stock market.
Me neither. I know you can lose money there.
Yeah, the Water Walkers of America. It's kind of cool. Which would you guys consider a better investment between IBC and a Roth IRA, or would you consider them two different ways to make money?
Let's go to Carson on this one. Carson talked a lot about this in Nashville. This is your whole presentation was talking about this. So.
Yeah, and the whole idea was, you actually answered it.
Mm-hmm.
They're different. They're different ways to protect, use, grow money. They're different vehicles. So you have qualified money, anything you can't touch to your 59 and a half. Anything you'd imagine, 403Bs, 401Ks, IRAs, Roth traditionals, SEPs, simples, all those types of retirement accounts. Then you have non-qualified money, which is everything else, basically. Anything you can use today, that's bank accounts, CDs, life insurance, and other things. And so you can't really cross money between these two thresholds very easily. And so how can you control money in both spaces? And I believe a Roth IRA in the qualified money space is the ultimate vehicle to invest with because it's all tax-free, obviously. But in the non-qualified money, what can you use? Well, you can use a life insurance policy to run your money through to go make other investments, just as we teach about with the whole concept. And so, yes, two different things. I would do both. You could even fund a Roth from a policy. So, you can't go the other way around, but you could. So 100% I'd use both, and it depends on what you're investing in, what you need to purchase, or if you have debt, it'll depend on what you want to do yourself.
Good answer.
Yep.
And just curious, why do you like keeping money on both sides, right? In qualified and non-qualified?
Well, personally, I don't put a ton on the qualified side, But most Americans have a 401k they've contributed to for a long time, and they have to leave it there unless they want to take the penalty and tax hit, which maybe makes sense. Maybe it doesn't. Might be over a few years you do it. And so in that scenario, maybe you have some sitting in a Roth or a traditional that you use and self-direct, and you could self-direct those retirement accounts, invest in what you want, have those investments be tax-free. And so you'd want money to be there. If you have it there, if you don't have any money in the qualified space, no retirement accounts at all, depending on your age, maybe it doesn't make sense to contribute towards it. Maybe it makes sense to run more through policies or real estate or your business. So it really depends on the situation in that scenario.
So Carson, you hit it spot on when you said self-directed. So
Yep.
they didn't put down their self-directed Roth. So
Good
that
point.
means that their Roth is still in mutual funds, giving that person the highest commission. So why don't you explain a little bit on that?
Yeah, that's a great point. So you have a Roth IRA, obviously, it sounds like, and that's probably sitting with Charles Schwab or Chase or JP Morgan or whatever, right? Fidelity. And someone else is managing it. Someone else is doing whatever they want with it. And all you probably know is if it's going up or down every quarter and if it's high, low, or medium risk tolerance. It's probably it. And there are ways you can use your retirement accounts with a lot more control than that. Fees are eating you up, inflation's eating you up, and volatility is eating the account up. That's why most people don't retire, because those accounts aren't doing what they expect them to do. And so you can do what's called a self-directed IRA. You could self-direct anything, 401k, 403b. You could roll your account over to a company that allows you to self-direct it, a company like Horizon Trust, and then you can use your retirement account and do whatever you want, whether it's lending and flipping a forklift or buying a rental or lending to somebody. You can invest in whatever you feel like investing in. It could be even stocks and mutual funds as well, if that's what you want. And so a self-directed account, what Joe is mentioning, is a specific type of retirement account where you control it.
Awesome answer.
Well, there's another question too. Water Walkers of America just replied again. And he said, is it correct to see the compound interest as building trust with the insurance? Well, I guess you're right. This is different than the retirement stuff, but maybe I'm already reading it. You want to pull it up and we can answer it?
Yeah.
Go for it.
Is it correct to see the compound interest as building trust with the insurance in the same way that you build trust through the credit system? IBC is paying yourself back. Traditional is others.
It's an interesting thought. I haven't thought of it that way. I think it's more that you have the opportunity. Like I was just kind of researching this and saying, well, other vehicles that you get compound interest, a CD, a money market, other accounts, it's not growing forever, uninterrupted, compounding in a guaranteed way that's tax-free. So it's really just asking, like, what is the thing that you could put your money in, have it growing forever, have it guaranteed to grow, have it tax-free, and simultaneously use the same dollar. Like you're saving in one hand and using the same dollar in the other hand because you're borrowing against the money that's compounding from the insurance company. So it gives you a lot more leverage. Like that's how I would look at it, Water Walkers.
Let's take it one more step. So we'll talk about, uninterrupted compounding interest. You brought up a CD. So Walkers can put this money into a CD, but now it's locked in there. But he's still earning the uninterrupted compounding interest. When we do the IBC, we're getting the uninterrupted compounding interest and still being able to use that money. So you're always earning the uninterrupted compounding interest. Different vehicles, when you take it out, now you stop it. Not with the specific design that we do and with the companies that we use because they're non-direct. So when we take a loan from the company, they don't see that as our deposit. So therefore, we still earn the uninterrupted compounding interest on everything that's deposited. Hope that answered the question. I like to give analogies.
Mon Jensen said, if there is a run on the banks and you have cash value in your policy, how do you suggest getting the money from the banks when the insurance company deposits the money to the bank account?
You're only going to put in the specific amount. As when COVID happened, they said you couldn't take out any more than 9,000. So therefore, you would drop the 9,000 in. 2 days later, see the 9,000, go in and say, give me the 9,000. You would only put in that specific amount. I think that's how I'm reading the question correctly.
I was saying you got to go where Brian is and go in the bunker. No.
No.
Right? Is he frozen or is he so
Oh, he
cold?
He's that cold. He froze.
Wave to him.
Oh, he's
There he
moving.
My internet froze because it's
I
cold
like when
outside.
he puts the hat on. It makes me happy.
Hey, this is my hair. All right. All right. So AJ said, does dividend pay every month based on the balance, regardless of the market tank of a market tank?
We're still talking about the market.
Yeah.
Why
So-
are we talking about the market? I thought we answered this question already.
So the dividends are on an annual basis in most cases, paid at the end of your policy year based upon the balance, but it's not based upon the market. So your policy. So not sure kind of what. Yeah, same as what Joe said. Why are we talking about the market again?
Well,
Yeah.
So for AJ though, I mean, if AJ's coming in without having heard this before and he's
Yeah.
looking at IULs and he's coming from an investment mindset, I mean,
Let's
like
tell
it-
him the difference.
yeah, if you like to, first, AJ, who do you want to be in control of your money, right? If it's you, then you're in the right place. And if you want your money growing in a guaranteed way where it's protected, where you have all these other advantages that's not tied to the ups and downs, because right now what we're talking about is completely different than anything that's going to be tied to your normal traditional financial system where things are going to go up, they're going to go down, you're going to buy low, you're going to sell high. We're not talking about any of that when we're talking about infinite banking. We're giving you a vehicle to control your money, to protect your family, and to do it in a guaranteed way, to take the risk out.
And AJ, we're making assumptions that you're kind of focused more on IUL, which a lot of people do because they're talked about in the marketplace as these great, amazing things, but we don't see them, behaving the way they're sold. And so what we're focused on is a whole life policy, especially designed whole life policy from a mutual company. The reason we focus on mutual companies and whole life is because there's guarantees in the contract. So you're going to have that guaranteed growth no matter what. And then the dividend itself is a non-guaranteed dividend, which means the insurance companies don't have to pay it. But every company that we work with have been paying dividends consistently for over 100 plus years. So we don't see that stopping anytime soon. So we look at a mutual company pays dividends. They've been paying them for over 100 years. We like that. The contracts have guarantees. We like that. And that's all opposed to the volatility of IULs and market, which is not what this is about. So those are two different camps.
He needs to know that some insurance companies use the stock market, but some companies don't. And those are called mutually owned. And that's the ones that we use.
Yep. Kind of a similar question here is how can the whole life insurance policy guarantee the growth of the policy?
That's a great question. I'm curious to see how you guys answer this one. I mean, one thing I always think about, I'm not going to answer the question like everyone else will, but one thing I think about is when you look at the fact that they've been profitable every year, like Craig just said, for 100 plus years, 119, 137, 148, 160, 170, right? There's a reason they're profitable every year. They're set up differently. And when they engineer the things the way they do, it's like if you're engineering a car, an airplane, you have the point where you're in the red, right? If you fly the airplane in the red for a long time, eventually, like the engineers engineered, so it's as soon as it hits red, it doesn't blow up. You can fly it that way for a long time, and eventually it puts the stress, it'll eventually break down. Well, everything is over-engineered when it comes to whole life, so they can deliver on the death benefit. So they over-engineer everything. And so if they're guaranteeing 2% or 3.25 or whatever the guarantee is in your contract, they know the math and the law of large numbers to where they can guarantee that happens. And that's why it's been profitable every year. It's just they over-engineer everything to really mitigate risk.
Yep.
And I thought that we were going to bring up Austrian economics.
I almost went there, but try to keep it as engineering.
I thought for sure that's where we were going to go. $1 for $1. That's how they can guarantee it. But that would have been the simple.
Yeah, I mean, the other aspect of why the insurance companies, the mutual insurance companies have been so successful is they have underwriting and actuarial sciences that are very, very dialed in. So when you go through this process, let's say that you wanted to get a whole life insurance policy, They're going to be looking at your health. They'll look at your financial background. They'll look at your criminal background. So they're looking at you as a whole, because at the end of the day, they're taking on risk, and the insurance companies want to manage the risk when they have a policy. So all those things Jason said, plus the risk analysis, plus all the underwriting they do, that's how they can be successful over time. And being in some of these rooms where the insurance companies are sharing their financial strategies, they're not out there looking for, the grand slam hit. They're looking for consistent, predictable returns. That's why they do a lot with treasuries and bonds. So they're not out there to, go out and make these huge returns, but they want to make consistently good high returns. Yeah. And that all fits into why they've done so well for so many years.
So what you're saying, Craig, is they know exactly almost when you're going to die.
Yeah, pretty much. And, and what kind of really blows my mind is when you go back in time and you think about the bank holiday in the 30s when banks got shut down, you think about the Great Depression, you think about world wars, banks failing. And what were all these mutual insurance companies doing?
Making money.
Paying dividends.
Yeah, making money. Being profitable. They weren't willy-nilly, were they, Craig?
No,
they're a little willy-nilly. They brought Joe on as a partner, but the rest of us, I could see why, we're able to be owners in these mutually owned companies.
But it just goes really to the foundations of how strong financially they are and how they've been able to weather these storms. And it's really impressive.
I was going to kind of go down the little rabbit hole of term insurance compared to whole life, because if somebody has a term life insurance, the insurance company would never have given them that term if the company thought for 1 second they weren't going to make it for that full term. That being said, what is the percentage of term insurance that actually gets paid out?
2 to 3%, isn't it?
I think it's 1 or 2.
So they're doing a really good job with what they know and doing that, unless you get hit by a bus. Now, what is the percentage of whole life insurance that gets paid out?
If it's in force, 100%.
Because nobody lives forever.
I was quoting something I heard that, 98% of us are not going to make it on Take Back Control Tuesdays, and no laughs, no Craig joke. Like come on. Like, no one's going to ask about the other 2%, like the Elons and other that probably will. I don't know.
They're going to download their consciousness into a robot. You just never know.
I don't know.
I like this question. Iman Jensen says, do you find a bank that isn't failing and then open a bank account there? Well, generally speaking, if a bank is failing, I'm not going to go open an account there. So, yes.
We've kind of talked about some of these different strategies in the past. And, if we're talking about a complete failure of the banking system, we have bigger problems than getting our money out to go buy groceries. You better have whiskey and tobacco and guns, I suppose. But one of the things, when Chris was on at one point, we talked about this, and his suggestion was think about sprinkling your money or having bank accounts at maybe a credit union, at a local bank, at a national bank, because unless the entire system just collapses, in that case, we have bigger problems. But if you've got a credit union, community bank, national banks, you've got some money in each one of those or some access to each one of those, it's pretty unlikely that all of those would fail.
Yeah.
The deal is going to the bank where the HELOC is, taking the money out of the HELOC, depositing that into another bank, because they won't close the HELOC down because you owe all the money to it, and the other bank is happy because you just deposited over there. So now you're just kind of protecting yourself between the two banks.
Dr. McFarland Studios says, how is a mortgage loan and a loan from a life insurance different?
Oof.
Possibly a mortgage is charged monthly and a simple loan is charged yearly. Hey, Joey, you want to explain that one?
Mortgage is nothing but amortization on a scale for 15, 20, or 30 years. Simple interest is how a HELOC is operating on a 30-day average. And the life insurance is done the same way. Simple interest, done by how long you've had it. If you take it out on January 1st and you keep that out for 365 days, then yes, then it'll be that exact number for that time frame. If it's taken out somewhere between or paid back at all, that interest rate will fluctuate on what you pay.
And Joe, I'm just, from a lot of people probably know this, but if you don't pay that loan on your mortgage versus you don't pay the loan on your policy, what happens?
You're in control. You're going to lose the house.
Your house.
You won't lose your policy.
Yeah. So it also comes down to a control aspect of the mortgage. We're going to be paying those payments, or they're taking our house. With the life insurance loan, you have leeway to pay it back how you want to pay it back. We do suggest you pay it back, but there's a lot of flexibility in there.
And Doc, I would say another piece of this is when you have a mortgage, like think of how the banks are charging that. You know when it's due, you know how much longer the term is, you know what the percentage is, and you know how much it is. They want their money in an orderly, timely, consistent fashion. When you have a policy loan, you can choose, we suggest, because it's called being your own banker, the verb of banking, that you pay it back the same way, but you have the flexibility to do that or not, or just pay the simple interest, pay it back in chunks. So you control that function.
Yeah. Yep. So Ahmad had a follow-up question. Says that's what I'm talking about. If the banks fail, how do you get your money out of your policy? If you have 100K in there, you can't draw it out because the banks failed. As Steven said, or someone else said, if that happens, or I think Craig, you said that, if that's the case and all the banks have failed, take shelter. Something else catastrophic has happened in the world. You might not be too concerned about your policy at that point in time. You might be more concerned about surviving. That would be
Brian's address is 1735 Wild Goose Lane, Idaho, something.
Yep.
Is he thinking? No, let's read this.
Uh-huh.
How do you get your money out of the policy if the bank fails?
Because we're saying we have to deposit it into our bank account to get access to it.
True. But I mean, I hope he doesn't think that our policy is in the bank.
No, I don't think he does. He's just saying if the banks aren't there anymore.
The banks are a piece of how we put funds in and take funds out.
Okay.
Yeah.
Which is a great question.
It is, yeah.
It is, but it's also it is, but it's always there's so much information on these things. Having boys, having kids, it drives me crazy. Some of the thoughts we have, some of the things we focus on. I would say go focus on what's possible versus it's always good to be prepared, but go focus on what's possible, what you can do, because we live in the greatest times ever. There's more opportunity. There's more things available that are going well than not so well. So,
but I mean, I want to bring up but when the whole world shut down, the banks were still there. They just limited how much you could take out on a daily basis. Because I did that. I lived that. So I went there for, 3 different times and kept on taking out money.
Yep.
So you would just deposit enough of money for that day and then go in and take it out.
And if bank 1 failed,
go to the
bank
next
2.
Put it in a different account. Yeah, you can change accounts on your policy.
Yeah, and if every single bank in the world failed, well, then I think the last thing you're going to be concerned about is you're getting money out of your policy. I'm not sure what you're going to do with it.
Could you send it to an international account?
I don't believe so. It has to be U.S. bank account.
Yeah.
So
there you go. All right. Brent had a question here. It says, about to pull my first loan. Congrats. That's awesome. From my policy, how long does it normally take for that money to be deposited into my account? Okay. So it should be a 1 to 2 business days in most cases. But you've got to make sure that if you're working with us, talk to your implementation specialist first. I've had 3 clients go and pull the loan first without talking to our team first. And the insurance company, mailed a physical check, which could take up to 3 to 4 weeks. So just work with your implementation person and they'll walk you through the process, make sure that it is all correct.
I'm pretty sure Carson, you're helping Brent, right? I just looked this up a moment ago, and if you just set it up, then maybe 30 days, Brent. If it's it can take 3 to 5 days sometimes. If it's a huge sum of money, I've heard like Devin or Brent mention it could be like 12 days. It just depends a little bit, like the questions that have been asked about the banks. How long are the banks taking to release the money at times too? It's not always on the insurance company and the function of what we're helping you do. So
yeah, and Brent, you definitely should meet with your implementation specialist because I know you were paying down some smaller little loans and cards and stuff. And so I would assume I mean, you've had a policy for a while, so you should definitely talk to your implementation person and plan which debts to pay down, how to pay it back, when to take your next loan. There should be a system behind what you're doing. So definitely talk to them. They can help. Or I can if you want to talk as well.
Yeah. AJ, another question here. How many people are in Private Money Club, ABS? How many have invested into deals this year? If I could give a steady 2 houses a week from Indiana, are there buyers?
About 8,000, I believe.
Yeah, so we got about 8,000 free members in Private Money Club right now. There's a little less than 1,000 paid Premier members. I think we're right around over 100 million in private money went through this past year. I can't tell you the number of deals, but just to be clear, who was that, AJ? Just to be clear, Private Money Club is not a platform where you post like wholesale deals or something like that. It's a place where you have houses you're looking to borrow money against to, rehab or whatever the case might be. And you're looking for the money to be able to do that. So, Carson is on Private Money Club. He's got his IBC policies and he's looking for ways to move his money within those policies. Well, he would find, AJ, let's say you have a deal you're looking to do a flip on, you need a couple $100,000. So Carson will say, okay, I'll lend to you at, let's say 12% annual return. You borrow the money for 6 months, 8 months, whatever it is, pay them interest payments during that time, and then return a principal with typically like a first lien position mortgage or in a promissory note, and doing everything the right way. But just to be clear, it's a community of real estate active investors that have opportunities and people like us that have money that are looking for opportunities and deals to deploy the capital to. So,
yeah. And I think you just said, if I had deals, are there buyers? That sounds like a wholesaler. So if you're a wholesaler trying to sell deals to people, that's probably not the place for you to go. You just want to go elsewhere and find legit buyers, and maybe the buyers would use financing from PMC. That'd be great. Or go in PMC and see if there's any people who are looking to buy and are looking for more deals in Indiana.
So there's a brand new, we just launched a PMC new platform. So there's a new community section. And one of the things, let me just share real quick. I'll just show you real quick. And one of the things I have not seen anybody do yet is start a wholesale community. So you might want to go in and take advantage of that. So when you first jump on PMC, you're going to kind of see the community page, of course, the deals page where you can post deals and things of that nature. But the community is where it's just open discussion. So you can join the different groups. You can find groups and you can create your own group, or just make a post on the general page. But what I would do is I would go and I would create a group around wholesaling, because there's a lot of active investors in Private Money Club. And so maybe you'll find people that are looking for wholesale deals, stuff like that. At the end of the day, though, it's all about building a community and building relationships in there. So definitely go in and start posting what you do. If you're a wholesaler, great. Just start chatting with people on there and building relationships and see where it goes. And the cool thing is, you might get to the point where you're like, well, hey, I got this wholesale deal I can make 10 grand on, but if I do the full deal, I can make 100 grand on it. So maybe you borrow the money from somebody on Private Money Club, because now you're plugged in the community and, you can make a lot more. Most wholesalers, not all, but most wholesalers like to keep a few deals for themselves that have high profit on them. And so that allows you a way to be able to do that too.
And congrats to Shane. I remember talking to Shane when he just started. He was doing velocity banking a few years ago and didn't have a lot of, extra capital to even start policies and things, but started policies, paid off all the debt. Now he's done 12 deals in Private Money Club this year. So that's awesome. That's awesome to hear, Shane. Keep rocking it.
Yeah, so Dr. McFarland said, my policy loans are deposited in a few days. So there you go, right there. Christian,
he had a statement above it, though, that I know you guys Joe will have fun with.
So Christian asked, how do I flip forklifts?
You got to be real strong. Got to eat your spinach.
Joe?
Gross.
Call up Archangelo and flip forklifts. You purchase the forklift. You get the bill of sale. It is yours. Then it goes around the shop and gets refurbished. Puts a new seat on, new paint, gets sandblasted, new stickers, and let's say he sells it for $10,000 more. So you bought it for 50, he sells it for 60. Now it's a 60-40 split. He keeps 60%. He gives you 40% plus your initial back. So you get your 54,000 and roll it back in and get another one.
That's right, man. Go to beyourownbanker.com, which is this site right here. Scroll down the page to the second section right here. case study flipping equipment. You can watch the little video on it. Click contact ARC, and it'll allow you to connect with ARC to do a deal if it makes sense.
Cool. DJ Scott says, how long does the medical exam stay valid for the insurance company, in particular if you wanted to open up another one after your current one gets enforced?
1 year.
Yeah, most cases, 12 months. They make you sign a waiver, right? Or a statement, correct? Say nothing's changed.
Well, it can be up to 12 months. You do sign something, but it's at their discretion. So if they want you to take another exam 2 months later, they can. But it's common for them to reuse medical though. Within a year.
Yeah, it's going to, again, depend on the risk. Like, they're not willy-nilly. Like, if say you had less than $1 million on your body and now you're trying to have another 3 or 4 or 5 million within a couple months, they might want to see a lot more things, or they will want to see a lot more things. So depends.
All right. What are all the ways to deposit to the account after you've taken a loan or used some of your money?
We got to get that video. Let's get the 90-minute presentation in the chat so AJ can get in there, watch that. And then also, AJ, get this book. It changed my life. It's the reason I'm standing here talking to you. So Becoming Your Own Banker, R. Nelson Nash.
You got the link, Stephen?
Giant font, giant pictures.
That is a good one.
Yeah, up to page 28.
So AJ said, I had an IUL and stopped it after I found the channel. It never started the whole life. Well, if you had an IUL and stopped it, and not sure where it was at in that process, but let's go ahead and see if a whole life makes sense.
Yeah.
You think it's probably a good thing.
Yeah.
Congratulations, AJ. Now,
I hope it wasn't too painful to stop.
Another one from Water Walkers. Is it a good action plan to do the 90-10 when young, under 30, to have higher returns for the real estate investments, and then to take out a loan from the 90-10 to put into a 60-40 after 35?
Okay.
There's all moving parts and pieces to that question right there. So
No, the answer is no. No.
People
no,
are getting
no,
stuck on
still
numbers. 90-10, 60-40, 70-30. I'm telling you, my money tree is based on a 50-50, and it's efficient in year 2. Where does this 90-10, 60-40, 70-30 even come in? People have to stop doing these numbers. It's not done that way. It's how the policy is built.
yeah, and we talk about them in some of the videos that Chris is out there, is where this comes from, but like that's what we do. We make these policies as efficient as possible based upon your situation, what you're trying to accomplish, what we're trying to solve. So that's where we say, yes, this is good information to know, but hop on a call with us. We'll walk you through it, and you'll get a lot better understanding of how this is all put together and how it can work for you.
But when you do come in, like, you have to be open to actually wanting to understand. Like Joe said, he can show you how, like, what's your goal? If you want to have putting money in year 2 and you have more money coming that you can use and you put in, then we can help you. If you're looking to have it grow over the long term, we can help you. If you're looking to reach your goals, we can help you. If you want a 90-10, we can't help you. Go find someone else. We're not here to change anyone's mind. That's my point. Because I have these cases like 90-10s, 80-20s, where people are coming in, they have one way they want to do it, and they can't tell you why other than they want to do it that way. And that's okay. It's just not us.
I think they're only thinking they want that 90% right away. So in the policies that I'm talking about, you have 93% in year 1. And then in year 2, you have 104%. But it's built on a 50-50. Oh, but I don't want a 50-50. But you want to make money in year 2, and you want 93% in year 1. It's not the numbers.
Yeah.
Well, and it's a good point. I think as well, what people just think, you want access to money. You want the 90%. Right. That's what people think. And that's where the misconception comes in. And that's fine. I get it too. But what Jonah Dew told me, and I think it's perfectly said, he said, we're building a family banking system for the next generation, for the next 100 years. So why are you going to dictate the next 30 days for the next 100 years of your life, for the next, maybe the next year of your policy to have a little more cash value? Versus having more cash value over the next 100 years? Your mindset's just wrong. There's no reason to have 10% more for the next year. Who cares? It's a long-term system we're building. And that's what people who teach this concept, selling 90-10 policies, don't actually understand. This is long-term. This is not short-term.
Because they are selling a product.
Yeah.
They are not solving anything.
Yeah.
I like what I think it's Brooklyn's Best is saying. Boring. You're right. Banking is boring.
Yeah. Well, you know what the cool thing about it is, if it's boring, you don't have to stay. Bye.
You're missing an R though. Are you missing an R to be Brooklyn Queen's Best?
But hey, I want to mention something on that 90-10 because it's a lot of people don't realize, but we are going to listen to what your objectives are and then design around that. But when you do a 90-10, it's oftentimes going to require a lot of term insurance, and we could potentially get a more efficient and a better performing policy if we back that 90-10 down. It's just that everybody thinks 90 is better, the 90-10 is better than everything, and it's not the case because there's other ingredients in there. I told someone the other day, I said, I'm going to make you a cake, a banking cake. There's going to be some sugar and some flour and different things. And you might come in really like sugar and you want to put just make a sugar cake. Well, that's not going to be a very good cake. So just trust that I'm going to put the right ingredients of flour and sugar and eggs and water. I'm going to make a really nice cake, but don't tell me how much sugar to put in there.
I mean, when I take the policy and I find the MEC line and I add $1, I can't get it any more efficient than that. So it doesn't matter if it's a 90-10 or 70-30. It's where that MEC line is, and I add $1. That's it. Done.
To Carson, what he said about what Jonah said, right? We're thinking long term. It all ties back to the principle. The first principle is thinking long term, thinking long range. It's not an immediate fix. How's this? I wrote this today, and I love it. I haven't said it to anybody else yet, but it's about 24 months of patience for a lifetime of payout. You guys like that?
That's cool.
You like that?
I do.
Yeah. I mean, because it's really usually the 24 months in the beginning, the year 1 and 2 that people worry about. Because by year 3, you're 80, 90% or more, depending on, the factors, the ingredients that Craig's talking about.
You're right.
Yeah, and Tess thinks I'm better with making cakes than cooking turkeys, but we'll see. I still think the microwave's the way to go.
You had Patty so freaked out before. I'm not even joking. Like, she was like, what? You can't do it. Tell him. It was awesome. I'm like, no, Craig's got jokes. That's all he does. So for anyone who wasn't here earlier, Mr. Craig is wanting to take care of Gina tomorrow on Thanksgiving. He's got a frozen turkey, a broken oven, so he's got to microwave that sucker. So he's told him to wrap it in tinfoil, stick a fork in it, and he's good to go, right?
Yeah.
You guys agree? Yeah.
It's going to be delicious. And put
I'm
salt
high for 5 hours.
High power. All right. What's our next question here?
AJ said, why did you say a lifetime of payments? Because, AJ, once you hit the efficiency point, every $1 of a premium deposit you're putting in gives you more than $1, and it's guaranteed to increase every year.
Yeah. And so it comes down to people looking at it as a bill, right? So when we get to a certain point, like, I don't want to pay this bill anymore. But when you start seeing what's happening long term in the policy, where you put $1 in and you might be getting $3 back, because of all the previous years of compounding, you've now got this machine rolling. Why would you want to stop feeding it? And so, Joe, I think you and I have kind of joked about this a bit, but you're like, I just want to be put on life support. Just keep me on life support. Keep adding the premiums every year, more premiums. Just keep me on life support. But
every day, that's another 10,000.
Yeah, so it's one of those things when you kind of think about it differently. Of if you're going to give me $1 and I give you back $5, when do you want to quit doing that?
Yeah. That's when people get worried. I've said this before, but it's been a while. Like if you talk to people that are closer to their retirement age about this, I'm like, yeah, just ask the people sitting next to you in the rocking chairs. Tell them that you'll pay them 10 or 20% or 30%, whatever you want, and you're going to get 200 or 300% on that money. I mean, just get their money and use their money if you don't have the money to make the premium deposits. Like, think like the bank. That's what we're teaching you, how to think like the bank.
Yeah, and AJ's asking when it can pay for itself, and there's different ways. If you do get to a point where you just don't want to put any more premium deposits in, the dividends can, based on the maturity of the policy, sometimes the dividends can cover the whole cost of the policy. So there's different ways to structure that, and that's going to depend on how the policy is designed. But let's say after year 10, you didn't want to put any more money into it. The dividends by then are typically going to cover the base or the minimum payment to the policy.
It's all about the base.
All right. So we have a couple more questions. We only got, about -1 minute left. Hopefully my wife does not unplug the internet again at my house. That's why it went off.
Oh, this is getting more fun. Oh, look, it is. It has been a long time. Look,
What do we got?
it's been over an hour when that thing goes off.
Yeah. So Ali says, okay, I want my son to be co-owner so he does not have to pay taxes when it's that time. So these are post-tax dollars, not pre-tax. So, but just talk to a tax strategist. We're not tax advisors. So there you go.
Well, and I don't know if she means when there's a death event, but at that point, the death benefit would be paid to your son tax-free.
She's saying
want to be the
co-owner.
beneficiary.
Yeah.
Your son would want to be the beneficiary because if something happened to you, then it goes to your beneficiary tax-free.
Yep.
I found out something cool the other day I didn't know. Like say I'm the owner on my wife's policy, and she's the beneficiary, right? Or no, she's not.
She can't be.
Yeah, not her. But when if the owner dies, it would go to the beneficiary, right? That would be the owner of the trust or someone else. So, that was a concern that someone brought up the other day. Like, what happens if I die? If I'm the owner, does my wife get to use the policy or whatnot, right? So
it's all part of your estate planning of what you want to have. That what do you want that asset to? Where do you want it to go? What do you want to have happen with that?
Yeah. Again, long range thinking. A lot of people don't think about this stuff, but it's good if you haven't had those conversations with your family to start thinking along these lines.
This is another mindset question.
Yeah. How many years is it best to wait before taking any money out so that the 5% interest rate is less than the profit coming in from the compound interest? They're two separate things. I mean, it depends on what you're doing with your money. It depends on how you're putting it to work for you.
I invest every penny that goes into my policy. As soon as it goes in, I take it out. And I'm making interest on that money.
Yep.
That money that I'm paying to the insurance company is menial because I'm making this interest from the investment, paying this interest to the insurance company while still making dividends and interest inside the policy. So that's kind of how your brain has to break that up. It's not the policy as apples and apples.
Yeah, and Jason, can you just read that quote again? Because I think this is applicable to this question. Your 24-month quote.
Oh, it's about 24 months of patience for a lifetime of payout.
So, I mean, what we're talking about there is the inefficiency of that policy where we're waiting for it to be efficient. But like Joe says, start using it now because that's going to happen regardless of whether you're using the money or not. And I think a lot of people that are new to this concept don't understand that piece of it, where it's going to compound and grow whether you're leveraging the money or not.
And whether you're using it as a glorified savings account or you're actually doing what we're teaching you with using it as a banker would.
Yep. AJ says, why would you say lifetime of payments? We don't ever say lifetime of payments. Sometimes you can if you want to, but you don't have to.
That was back to the quote that I just read. He was asking about that. So we got that.
When someone said, when's it pay for itself, which is what AJ is asking, year 8 to year 11, in most cases, depending on how you build it and how you fund it. But bottom line, it depends. And also, if you can put in $1 and get $3 out, why would you want to stop? So that's something that we walk you through and work with you on.
I think they want to hear numbers. In year 11, with 90% of the policies, you're at about 200 to 300% cash on cash.
Yeah. All right. Let's see here. What other questions we got? I know we were over time already.
There's a couple. What? Almost got them?
Yeah, Walker America's at $125K annually with 25 of monthly expenses. What would you guys suggest if my goal is to have 25 properties in by 45 years?
Ooh, I know. Start. Yeah.
There you go. I was gonna say, just schedule a call. I mean, that's the best thing is watch the video, schedule a call. That's where you want to start right there. Because obviously this is something we can work with you on, but more on a personal one-on-one basis for sure. But good question though.
Yeah. And quick too. Hey, if you're 25, dude, let's chat. I'm close to your age. I'm doing exactly what you're talking about. I'm running all my income into buying real estate, and doing all the cool different tax tricks and using life insurance and all kinds of stuff. So let's just have a quick conversation. Just shoot me a text or DM me, dude. DM me my name. Look up Carson Aline on Instagram, and we'll chat.
I have to. What's going on, Justin?
What's up? So I have a small policy with One America. I know I have to manually call and pay my premiums for the year. My second policy is Lafayette. Is that the same way, or can I auto draw every year?
I don't know why you're
having
why you have to call.
Do it online. Well, you can do it online.
If it's with us, talk to your implementation specialist. That's the person that can help you with this the most. But I mean, you should be able to pay it online. So yeah, that's gonna hurt.
So I just did the Lafayette, Justin, and I did it right online.
Okay. There you go. Knights of Israel. What is the premium deposit? How large of a range can you have? There's a lot of factors. We'd have to know more details on gross income, age, other factors to know that.
He wants to know the max, 5 million.
Yeah, there you go. And then, can the lower end of the range ever be less than 10 times your age? Yes, it can. I've done many of those, but it's not normal, by the way, because it's just not attractive. But they're doing some unique things, but it can be in certain scenarios. Carson's last name is
What problem are we solving?
exactly. Like, why would you want to do that? It's kind of the question. Carson's last name is Herlean. Somebody just asked that question.
Yep.
All right, I know.
Thanksgiving all.
Yeah, there's some more questions here, but guys, we're gonna call it. I got to hop on a call right now. Appreciate everybody being here. Appreciate all the questions, and we'll see you on the other side. Do we have anything else going on this weekend? No, we don't. Cool.
Be blessed. Have a good one all. Bye, guys.
Bye-bye.